Okay, we're going to wrap up our look at Chapter 4 by looking at a comprehensive example, problem 14 from your text. This problem that I'm looking at is more comprehensive and covers more things than what you're going to have in your homework, but I think it's a good example for me to demonstrate to show how all of the pieces combine and what a more complex worksheet actually looks like when you put all of the pieces together that we've covered up till this point. So in your text, you'll see that the acquisition date that I've highlighted here in yellow, and I recommend you start keeping track of when the acquisition happened versus the consolidation, because remember again, this is not part of a general ledger. We have to account for prior periods. So it helps us to keep in line, and it also helps us to remember where to look for the information. So the date of acquisition here is actually on the prior page, and it tells us that the percentage that was acquired was 80%, and for that value the parent paid a price of $300, and we know from our previous examples that we use that 80% at 300 to imply a total value for the subsidiary. And the NCI here then has a value of $75,000. Now we compare that to the book value that's on page 261 because again we want to take it at the acquisition date, not the later date in which we're consolidating. So we need to look at all of the pieces in the subs equity at 1/1/2011, and we see that we are picking up 160,000 of equity. That means that the excess that we acquired is 215,000, and that 215,000 then we allocate, as we've seen in prior examples, to the things that are undervalued, and the last resort being goodwill. So let's finish up the distribution and determination schedule here like we've done before. Remember, the line that I'm working on right now is the line that will be part of our D entry when we distribute the excesses, because we distribute between the parent and the subsidiary. And we see that we have a total there of the 215 that is going to be distributed based on the 80% ownership for the parent, 20% ownership for the NCI. And that line right here becomes our D amount. So we could go ahead if you want and highlight that because we're going to come back to that. The excess here, if you do the reading, is allocated to a building for 100,000, to equipment at 50, and the remainder then becomes goodwill, which is 215. And we'll put in our sums here to make sure that it all equals out and that we've allocated the full 215 to those three items. Now you'll notice on this template that I pulled from the publisher's website, I've not used certain pieces of it because I think it's redundant, but I have left in some of these amortization schedules. Now it's up to you whether you use them or not. If it helps you or if it's distracting to you, it's up to you. But this first one is going to factor in our A entry. So the amortization schedule here is our A entry, and we have to consider that those two depreciable items, buildings and equipment, have a useful life that is eventually going to disappear, and therefore what's the depreciation of that excess? So our building amount over 20 years means an annual amount of 5,000. Our equipment has an excess of 50 over a 5-year life means 10,000 for the equipment. So our annual amounts are $5,000 and $10,000. Now the helpful part of this schedule is it helps remind us what year we're in. And as you recall from doing the date, our acquisition was 1/1 down here on the worksheet, and from the text you'll see that we're at 2012. So we had all of 2011 and all of 2012 to account for. So our prior year here is 2011, current year 2012. Again, if that helps, go ahead, put it in to help keep track of it. So each year we know we have to do this. So in this case, those are our current year. Only one prior year here. If it was 2, we'd obviously multiply it by 2, etc. And then our total column is what will become our accumulated depreciation amount in our distribution or amortization entries. So those will be our A entries. Now the red box, the next one, is going to relate to intercompany transactions. And we need to go back to the reading at this point. And if you pick up from the reading, on January 1st, Salmon held merchandise sold to it by Purple for $14,000. So there was $14,000 at a percentage of 40% is the applicable gross profit given there in the text. During the year, they also sold merchandise of $60,000, which we'll come back to in our IS entry. And then on December 31st, they held $12,000 of inventory. And this inventory was at a 35% rate. So that's just information we're filling in that was given in the text. And again, you can use the schedule if you want, you don't have to. The profit factor then is the math combining the total amount times the gross profit percentage, and that profit factor is what we take into consideration for our EI or BI entries, our beginning inventory amounts. So then it says Purple held $12,000 worth of merchandise in its beginning inventory from sales from Salmon. So Salmon had $12,000 that it sold, and the profit factor on that was 25%. And then if you keep reading on down, ending inventory had $16,000 at a profit factor of 30. So you'll see here there's more complications than in your homework or in most problems that we're going to look at, but it's very possible in real life that you have intercompany profit or intercompany sales going both directions. So like I said earlier, this gives us a great chance to combine different pieces and show the full impact. Then we also had some equipment sales. Purple sold equipment to Salmon at a profit of 40. So the original profit is 40,000 at the parent, and it happened in year 1. So in prior years, we've already taken a portion of this, and it said it had an 8-year life. So we've already taken 5,000 of that, which means that there is 35,000 left. Again, this will help us with all of our entries as we come to the worksheet if we fill this all in up front. There was also in the next paragraph at the beginning of 2012 a sale from the sub that had equipment with a book value of 30, but it was sold at 54, so there was a profit of 24. That happened in year 2, so nothing could have happened in prior years, leaving the full 24,000 as a gain that we're going to have to eliminate. But we are going to have to start depreciating this, and it's over a 6-year life, so that'll be 4,000 a year for that. So like I said, these 3 schedules, the A, the inventory, and your F items for intercompany fixed assets, these are good schedules to help you accumulate the information, but it's up to you whether you use them. The income distribution schedules we'll come back to when we get to the point where we can allocate profit. For now, let's go ahead and skip down to the bottom and start filling in our entries. So we know our CY1, and I highly recommend, especially as you look at this problem, you'll see why. I highly recommend that you go in a certain order and that you are consistent. I like the particular order that I demonstrate to you in all of the homework and the things that I do for you as examples, because to me it makes a logical sense in terms of how it flows with the text, how it flows with the transactions. But you don't have to stick to that order as long as you're consistent and as long as you make sure that you don't forget anything. Okay, so I'm going to start off with my CY1 and 2. CY1 comes right from the worksheet. So we see that in the parents' general ledger, they show subsidiary income of 23,600. We're going to eliminate that. And we know that that goes against the investment because that's what the parent recorded under simple equity. For the dividends, we're interested in the dividends that were declared by the sub. You see up in the sub's ownership, they declared dividends. As the parent, we're entitled to 2% of that. So 8,000 is our CY2 entry. So that'll take care of our first two entries there. And we can move on to our EL entry. EL, remember, is eliminating the subsidiary's equity. So again, if we scrolled up and looked at the equity, we see here the equity for the sub of 10,000, 90,000, and 142. Well, again, what we're eliminating is our ownership percentage. So we're going to take the 80% of each item as our elimination amount. And the combination of all three of those is what's eliminated against the investment account, back to Chapter 3 and that relationship between simple equity recording and the investment account and the underlying subsidiary equity. And now we're to our D entry. Our D entry, as you recall, comes from our DDE. So we're interested in that line item and our excesses right there. That becomes our D entry. So down below we're going to record the building excess of 100, our equipment excess of 50, goodwill of 65. Then we saw in the DDE 172,000 is parent and 43 is NCI. So that's our D entry. Then we're moving on to our A entry. Our A entry comes from this amortization schedule and the amounts that we calculated here. So we're going to record the prior year and the current year. So the current year for the building was the 5,000, and for the equipment the current year is 10, and then the combination of those obviously was also done in the prior year. Now, because again we're talking excesses related to the sub, those excesses belong partly to the parent, partly to the NCI. So in total it was 15,000 that was taken last year. 80% of that is parent and the other 20 is the sub. The total accumulated is the 10,000 for the building that was in our schedule up above and the 20,000 for the equipment, or the combination of the 2 years. So that's our A entry. It's through Chapter 3, just reviewing our entries from Chapter 3 from CY1 through our A. Now in Chapter 4 we started adding our intercompany transactions, and we saw from our analysis up above that there was inventory transactions. So we've got our BI, our IS, and our EI entries. If we go back up to that inventory schedule and we look at the beginning line, we see that there's 2 profits that we need to eliminate. Okay, the 5,600 fully belongs to the parent, but the 3,000 has to be split between the parent again and the NCI.